Welcome back. You're tuned in to Investment Guide here on CNBC TV 18. Well, we are in conversation with Anshuman as well as Murtuza. Murtuza, let's come across to you. I want to understand what are the key parameters you look at when you're analyzing a Realty stock. For cement, we look at EV upon, EV per ton. For Realty, what is it? You can't look at a simple P&L. Is it inventory to market capitalization or what?
Sure. So, the accounting for real estate is slightly more trickier compared to most other sectors. And the reason for that is, if I were to make sort of comparisons, the working capital cycle is long, right? So it takes almost about 4 to 5 years at least before you sell a product and you actually deliver that. And the revenue recognition happens towards the end after sort of delivery of the product. So the cash flows versus the P&L is completely different in sort of residential real estate compared to conventional businesses, which is why it becomes difficult. I think a more appropriate measure would be to look at the valuations versus the cash flow generation. Key parameters that we look at, when you're looking at residential, we look at the sales velocity. We obviously look at the margins, the reported P&L margins that they are making on projects. And also, it's also very important, Nigel, when you're looking at real estate stocks, that you distinguish the kind of various buckets the business are in. So there could be residential business, there could be the commercial, there could be some hotel ownership, as well as the land bank. So these are the broad sort of categories. And each of them have their own sort of monitorables. The ones that I highlighted were on the residential. If I were to look at the commercial piece, I would be looking at the leasing activity, the occupancy levels, etc. And there, the earnings trajectory is more consistent, and one could look at an EV/EBITDA if one is looking at the commercial business. It gets tricky in terms of the accounting of the residential business.
Okay, got that. So that's really helpful, I think, for a lot of newer investors who want to approach stocks themselves. Those are some parameters that perhaps we can look out for. But let me now take a question with Anshuman. Anshuman, we've spoken a lot about residential. I want to now pull your attention to the office side of the market as well. Now, if I was a big ticket investor and I was willing to write you a big fat check, would you tell me to go ahead and invest in the office market as of now? Or would you stick to residential? Because with this whole COVID, work from home, there have been question marks raised about the level at which we'll see office space absorption.
See, first of all, yes, I would recommend to invest in the office sector. And the reason are many, and I'll highlight a few of them. One is that India is an offshoring destination for the world. We have skilled manpower available at a competitive price. And that cost, leaving the cost aside, and the cost remains competitive, not only because of the difference in, of course, wages, but also because rupee keeps on depreciating. So one is the cost side, but also what is equally important is skilled manpower. Although at one end we feel that we don't have enough people, but relatively speaking, we do have skilled manpower. So that will ensure that India remains the offshoring destination. And also because it's got an established track record of providing services where for a lot of multinationals, they saved millions of dollars over the years, thanks to having their offshore centers here, be it business process outsourcing, software development, etc., design, whatever it comes, IT, ITAS. And no doubt there has been a slowdown in absorption of office space vis-a-vis last year. But the good part is, the bad part is that last year was a record year, the best ever, where more than 60 million square feet of office space was absorbed. And this year, thanks to COVID, that number will come down. However, I do expect a recovery, especially that thanks to COVID, I would say, and that's only thanks to COVID, everything else is terrible, is that because in the economies have slowed down in the West, they need to be more competitive, they need to cut costs. And one major way to cut costs is by offshoring. And to remain competitive, they have to do it. And India will get the benefit of that offshoring. So I do expect the office market to recover faster because of this. And therefore, with institutions player coming into it, will encourage even the investors, both foreign and domestic, to invest in this market.
Murtuza, let me quickly draw you into this chat as well. When we speak office, again, from the stock market point of view, we also have the option of REITs, right? We at least have 2 listed REITs today. A, how do you gauge their performance? Would you advise people to use this route to invest in office and commercial real estate at all?
Sure. So if you look at rates, essentially, it's sort of an offshoot of the real estate stocks as well. But the difference being the risk of investing in a REIT is lower than a conventional realty stock, because there the developer is, right from the stage of acquiring the land to building the office to leasing it out. Typically, because of the way the regulations on REIT structures are, and they're supposed to be income yielding sort of investments, you're getting a fully ready sort of a portfolio of operational assets which have already been leased out. And if I were to sort of draw comparisons, if you were to look across sectors, if you look at the first and second quarter of the sort of current fiscal, REIT earnings have been most stable compared to any other sort of sector out there, where they pretty much made good all of their rents and collected all of them. So it's been a fairly safe investment. Yes, they've had their challenges in terms of incremental leasing, but that's on the margin. If one were to make a comparison between investing in a real estate stock, which probably has commercial real estate, versus investing in a REIT, the differential is the risk parameter of a REIT is lower compared to conventional real estate stocks. And the dividend yield, given that REITs have to sort of compulsory pay out 90% of their distributable cash flows, so it's more income yielding. So it's more a lower risk. If one were to look on a risk-adjusted basis, REITs make for a fantastic investment opportunity, one which was not available previously to the Indian investor. You have the two extremes. You either had the equity or you had conventional fixed income if you wanted an income yielding asset. So the REITs really fall somewhere in between, which deliver superior risk-adjusted returns.
Well, Murtuza and Anshuman, before we wind this down, one big question that everyone will want to ask, and my heart skipped a beat when Surbhi said earlier, I want to write a big fat check. I'm sure a lot of people out there would like to know which
in my head, we can do this.
A lot of people out there will be wondering which stocks should they buy. So, Murtuza, top buys from the sector, and Anshuman, if someone is looking to buy some real estate, physical real estate, where should they be looking at? Go ahead.
I think from our coverage, we would put DLF, which is NCR based, and they've got a large pipeline of development portfolio, almost 29 million square feet, which they're looking to develop, which could create the next leg of value should this sort of positive momentum continue. Oberoi and Shobha, so that gives you a nice spread. DLF is more NCR based. Oberoi amongst the Mumbai real estate companies, and Shobha for Bangalore.
And again, DLF and Oberoi, we get that. Murtuza, Anshuman, you?
Shobha, DLF and Oberoi. He's picked one in each city.
All right. Anshuman, what about you?
You're asking for locations. I'm not going to recommend any stocks.
No, physical investment. Where does one put money and hopefully get a decent return?
The big fat check is ready.
I would say still stick to, first of all, to the major cities, which is, NCR, Bangalore and Mumbai for office, because, and there are now opportunities not only buying REIT, because that's what someone who doesn't have a big fat check, but a big fat check, there are startup-owned office spaces, buildings, because now what was not happening earlier, where people used to develop office space, rent it and hold on to it, now they're coming up in the market. The yields are good. So certainly in these three cities, I would say there are good opportunities. Commercial and residential, I would say across the board, besides the apartments, etc., where you can get good structured deals depending on, of course, location within the city. And there are also opportunities, plotted developments, which was not coming earlier. Okay. So besides the three cities, the two other cities I feel which have really come up since last 4 or 5 years is Hyderabad and Pune.
Okay.
And the reason is because they are magnet for talent.
Sure.
The job markets are strong there. And they will see good growth going forward.
All right. Okay. We're completely out of time, but we get the gist of it. Gentlemen, thank you so much. It gives us some clarity and some understanding of this pickup that we're seeing in demand in real estate pretty much across the country. Many thanks for joining in. Nigel, I'm going back to my little humble FD. There is no big check, let me tell you that. Well, with that, we're completely out of time. So it is a wrap from Nigel, me, and the entire team. Many thanks for watching. We'll see you again next week.